Hello and welcome. Before slipping into a short break, we were getting you live updates from the SEBI board meeting where SEBI board has revised mutual funds expense ratios, excluding statutory levies upon STT, GST and also stamp duty from base expense ratio. BR for index funds and ETFs have been lowered from 1% to 0.9%. The board has also approved simplifying offer document summaries for clearer disclosures and allowing debt issuers to offer selective investor incentives in IPOs. Now, to discuss this and more, we have like a couple of guests joining us on the show. First up, we have Shriram Subramanian, who's a founder and MD in Govern. Shriram, you heard the updates from the SEBI board meeting. Your initial reactions on that?
I think these are very welcome developments. Firstly, simplifying the norms for brokers and ensuring that the rules are codified and much more simpler for the brokers. Two is for the mutual funds. This is investor friendly because they are capping the expense ratios, ensuring that the mutual funds don't overcharge, etc. All these, of course, benefit the eventual mutual funds. As such, mutual funds have got a lot increasing funds, and their assets under management have increased while their costs have remained stable. So to that extent, these developments by SEBI are very welcome.
Specific set of reforms which balance aggressive transparency in mutual fund with stricter internal ethical code for SEBI itself change the trust deficit between the regulator and the retail investor, according to you?
Yes. As I told, definitely fund management houses have seen a lot of inflows while their cost structures have not gone up. So to that extent, passing on the benefits by capping the expense ratios to the investors is very welcome development. Two is obviously all these changes in norms of reporting to SEBI and simplifying the frameworks enhances the entire compliance burden on the fund houses itself. Three is making more, I think SEBI's inputs on investor education or trying to educate more investors. You have seen the recent orders on influencers, etc. All these are welcome because at the end of the day, there has to be greater investor education because more than 50% or even more of investors, retail investors have joined post-COVID. So to that extent, and they're of a younger age. So financial education and investor education is very important. And all stakeholders have to work towards that.
Yes, for sure.